Hey everyone, welcome back to the channel. If you've ever looked at the stock market and wondered, why do some investors pick stocks that look boring today, but explode in value later? The answer is usually fundamental analysis. So grab a notebook, hit that like button, and let's dive in. Section 1. What is fundamental analysis? Think of a company like a car. Technical analysis looks at the speed, the price going up or down. But fundamental analysis opens the hood. It asks, how good is the engine? Is the company built to last? Can it outperform other cars over the long run? In simple terms, fundamental analysis means evaluating a company's real value, its financial health, its business model, its management, its future growth potential. Investors use FA to answer the big question. Is this stock worth buying at its current price? Section 2. Why do investors use fundamental analysis? There are 3 big reasons. 1. Long-term growth prediction. Fundamentals show whether a business can keep performing for years. 2. Spotting undervalued stocks. A stock might be priced cheaply today, but worth much more based on its fundamentals. 3. Avoiding bad companies. Sometimes a stock is popular, but inside the company, the numbers are weak. FA helps you avoid disasters. Warren Buffett literally built his career using fundamental analysis. Section 3. The 2 types of fundamental analysis. A qualitative analysis, the non-numerical side. This is the story behind the company. What does it do? Who runs it? What gives it an advantage? What is its reputation? Is the industry growing? Be your quantitative analysis, the numerical side. This is the part with numbers in the financial statements. Revenue, profit, debt, cash, growth rate, margins. For today's video, we'll focus more on the qualitative part because it's easier and more intuitive for beginners. Section 4. The business model. How does the company make money? Before looking at any ratio or calculation, ask the most basic but powerful question. How does this company actually make money? A great business model is simple to understand, sustainable, scalable. For example, Netflix makes money from subscriptions. Apple makes money from hardware plus software ecosystem. Google makes money from ads plus cloud services. The clearer the revenue engine, the easier it is to analyze. You should ask, is this business model future-proof? Is it dependent on one product? Does it require too much capital to grow? Section 5. Economic moat. Does the company have an edge? A moat is a long-term competitive advantage. Examples: Apple has brand loyalty. Coca-Cola has massive distribution. Amazon has scale plus logistics. Google has search dominance. Ask yourself, can a new competitor easily copy this company? Does the company have patents or unique technology? Does it benefit from network effects? Companies with strong moats often survive downturns better and grow steadily. Section 6. Management quality. Numbers only show part of the story. The people running the company matter a lot. Good management has a clear vision, uses capital wisely, doesn't hide problems, focuses on long-term growth, not short-term hype. Look at CEO track record, company culture, insider buying or selling, transparency in communication. A great management team can turn an average company into a great one. Section 7. Industry and market conditions. Even a great company can struggle in a bad industry. I ask you something. Is the industry growing or shrinking? Are new regulations coming? Is the market becoming more competitive? Are customer preferences changing? For example, renewable energy is booming. Traditional cable TV is shrinking. AI and cloud computing are expanding. Brick and mortar retail is declining. Always check the environment the company operates in. Section 8. The company's financial health simple version. Here we keep it very simple. No heavy calculations. Look at 3 basic numbers. 1. Revenue trend. Is the company making more money every year? Growing revenue equals customers want the product. 2. Profit trend. Does revenue turn into actual profit? Some companies grow but never make money. 3. Debt level. Companies with too much debt can collapse when interest rates rise. Is debt manageable? Is cash flow strong? Does the company reinvest wisely? Even without complex ratios, you can get a clear picture. Section 9. Intrinsic value. The core of fundamental analysis, intrinsic value simply means what a company is truly worth based on its fundamentals, not the current market price. If intrinsic value greater than current price gives the stock may be undervalued. If intrinsic value less than current price gives it may be overvalued. We will go deeper into valuation, ratios, and examples in Part 2. This is Part 2 of our Fundamental Analysis series. In the last part, we understood what fundamental analysis is and how to judge a company's story, business model, moat, management, and industry. Section 1. The 5 most important ratios. No complicated math, just basic understanding. 1. PAE ratio, price to earnings. This tells you how much investors are willing to pay for $1 of profit. High PE gives expectations of high growth. Low PE gives maybe undervalued or maybe a bad business. Compare POE to the company's past PE, competitors, industry averages. You don't need to calculate it. Every finance website shows it. 2. PEG ratio, price earnings to growth. This adds growth into the picture. PEG approximately equals 1 gives fairly valued. PEG 1 gives possibly undervalued. PEG greater than 1 gives possibly overvalued. This is helpful for fast-growing companies. 3. Price-to-book ratio P/B shows the market value versus the company's net assets. PAB 1 gives can indicate undervaluation. PAB greater than 1 gives normal for tech companies they have intangible assets. This is especially useful for banks and financial companies. 4. Debt-to-equity ratio DE measures how much debt the company uses. High DD gives risky. Low DD gives safer, but may grow slower. You don't need exact numbers, just watch the trend. If debt keeps rising faster than profit, that's a red flag. 5. Return on equity ROE shows how efficiently the company uses investor money. Higher ROE equals better. Stable ROE over years is ideal. Aim for companies with consistent ROE, not one-time spikes. Section 2. 3 key statements you should understand. Without going deep, here's what matters. 1. Income statement shows if the company is making money. Focus on revenue growth, net profit growth, operating margin. 2. Balance sheet shows what a company owns and owes. Focus on debt, cash, total assets. 3. Cash flow statement. This is more important than profit. I ask, is cash flow positive? Is it growing? Does the company generate enough cash to pay debts and reinvest? Companies can fake earnings, but cash never lies. SECTION 3. Intrinsic value simple version. We're not doing complicated formulas like DCF here. Here are simple methods beginners use. Method 1. Compare PUE to industry average. If the company is growing faster but has a similar or lower PD gives undervalued. Method 2. Earnings growth trend. I ask you, does this company grow earnings every year? Are profits stable? Stable. Growing companies tend to be undervalued when the market panics. Method 3. A simplified fair value estimate. Here's a simple beginner formula. Fair value approximately equals current earnings times normal PAE range. Normal PAE range is usually between 12 to 20 for most companies. If the stock trades far below your fair value gives undervalued. You don't need exact numbers, even rough comparisons help. Section 4. Red flags to avoid. These are signs a stock could be dangerous. 1. Rapidly increasing debt. Companies borrowing more than they earn are risky. 2. Falling revenue. Every year, a company losing customers will struggle long-term. 3. Negative cash flow for too long. New startups may survive, but established companies shouldn't burn cash. 4. Overdependence on one product. If one product fails, gives the company fails. 5. Management scandals or lack of transparency. If management hides information, run. Section 5. A simple 10-step checklist. Here's an easy routine you can use for every stock. 1. Understand the business model. 2. Identify the company's moat. 3. Research management quality. 4. Check industry growth. 5. Look at 5-year revenue trend. 6. Check 5-year profit trend. 7. Review debt levels. 8. Check cash flow. 9. Compare key ratios PE, PAB, ROE out 10. Estimate fair value basic comparison. If a stock passes 7 out of 10 points, it's usually worth deeper research. Section 6. Long-term investing mindset. Fundamental analysis is not about quick profits. It's about buying great companies, holding them long-term, ignoring noise, focusing on real value. Remember, you're buying part of a business, not just a stock price. Don't forget to like, subscribe, and share this video with someone learning to invest. Thanks for watching, and happy investing!